Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So again, now what do? I'm going to check my daily chart here to see what's going on. I made a note that we did move into a higher range between 118.70 and 129.90, and that a symmetrical triangle formed inside the weekly chart, and I noted that on 129, and then the CDD broke out of the weekly triangle to the upside at the end of the last week in February. Well, we need to see why that is. What's the clues that we could participate and try to buy with little risk to take advantage of that? Again, looking at our weekly chart, there's our actual breakout in the last week of February. But if you went back down to a daily chart, this is where the sentiment of the traders is even more evident and easier to see. Because inside of our weekly triangle, notice how I start making higher lows inside of my daily triangle. So this is the clue to me that the buyers are winning this battle. They're paying higher and higher prices, 119, 120, 121, 122. The sellers can't push prices down. So this is a clue that maybe this triangle is going to resolve to the upside. Okay? And really, that's all it is, guys. You're planning your trades. You're trying to come up with a logical set of reasons, simple rules. You're looking for the lowest risk entries you possibly can take when you take these trades. If you miss the entries way down here at 104, we have to deal with the here and now at 125. What do we do? So that one there had a nice little breakout. So inside my weekly symmetrical triangle for the Canadian, the dollar versus the Canadian, was a daily symmetrical triangle showing buyers in control. The angle of the ascent is favoring the buyers who are willing to pay higher prices on any weakness. And I use the daily chart for a long entry to reduce my risks because now I can place my stop loss below the pivot low next to the entry candle. If the dollar does start to sell off, I don't have to worry about it. Okay, and I can also watch it on the daily chart during the week. And here we go again. This is 223. We're still inside the triangle. I actually did a webinar for another website and suggested that if you wanted to buy that trend line at this time, that you just put your stop loss below the prior low so that you're defining your risk. Okay, and then we broke out to the upside of the triangle a couple of days ago. So we're going to probably go and test that 130 high again. If you're in there from the breakout at 125, that's a nice little move, but make sure you take something off. Quadruple tops are rare, but they do happen. Next one is our euro. Okay, this one pretty much looks like a beautiful stage one accumulation after a big sell-off back at the beginning of July, the end of June. The clue I have inside here that we may break out to the upside is, again, look at if I drew my trend line, which I didn't on this chart, but I could have started to draw what we call an ascending triangle right here across these higher lows. So again, this is another clue. In Forex now, remember, you don't have volume like you do in the stock market or in the index markets. So what you would want to do is to kind of give yourself a clue that the sentiment is shifting towards the buyers. If you see an ascending triangle forming inside one of these accumulation ranges, that's kind of a sign that people are itching to take the prices higher. So my suggestion, again, was to buy 65 calls on a breakout. Okay. We had a nice little breakout that got up to about 67, 68, and we hit some resistance on the left. I want you to pay attention to these areas to the left here. These represent areas where you're probably going to find some willing sellers, so they're good areas to take profits on the way back up. We based after a while so that we could, again, absorb the supply to the left of us here. Okay. We broke out of that range and started to move up again, and I'm a nervous Nelly, so I'm drawing my trend lines, and when I get a nice steep angle, I'm drawing steep trend lines, because if I break that trend line and I want to re-enter, I can always re-enter on a trend line that doesn't have as steep of an angle. And anytime I see prices move like this, I consider it to be parabolic and usually not sustainable. But it was. We hugged that same trend line for a long, long time. And I drew another trend line in here for a medium-term trend line and a longer-term trend line. But again, we broke out of a stage 1 into a nice stage 2, so that means we're going vertically up. And so I'm drawing trend lines just to keep myself focused on vertical movement versus horizontal movement. That area between 72 and about 70 or so was down here, but then we exploded again, and we got to this range between 76 and a little over 80. And right here, I write on my chart, it's going to be a stage 3 top if I break below 76, or it could be another accumulation if price wants to go higher. So I'm not predicting what it's going to do. I just intend to react depending on what it does. I noted on 11/13 when I was on the last time that because the dollar had broken out against the pound, it made a breakout to the upside by the dollar versus the euro likely. Well, pretty much that just means that if one currency starts moving higher, most of them will usually follow along. Some of them will move at their own pace and they'll lag a little bit, okay? So I said here the premium right strategies would give away any upside potential. Worst thing in the world that you guys can do is give away upside potential. Once you break out and start moving vertically, you want to, of course, hold on to those calls as much as you can. So using a put at the bottom of the range at that time would make more sense as a way to hedge that position. And I noted here the best lesson is to be prepared for any opportunity because price is always dynamic. So again, if I'm planning to hedge, I have to be flexible. I have to be willing to make changes. In this case, though, this is one of the currencies that actually completed the 4-stage cycle, and we absolutely collapsed below 76 all the way back down to 62. And that was the first place on the chart where we found a little bit of support at that time. So fundamentally, a lot of reasons probably why this happened. All of a sudden, the United States confidence in the dollar went away, and people were saying, oh, it's not as strong of a safe haven currency, and gold started to take off at that time. So at the beginning of January, we completed the stage 4 cycle that started in July. Stage 1 accumulation, a nice uptrend, a top, and a big drop. Okay? So at that point, we also started to rally back up to where this breakout occurred at. Now notice, I always write on my chart, old support's going to become new resistance. And the stage 3 top thing was left over from the last time we were up here. Now why do I write that on my chart? Because option traders need to be aware of prior support and prior resistance. If you're going to buy a call option when you're hitting a resistance level, you're going to lose money because you're going to lose due to volatility crush, and you're going to lose to time decay. So in other words, first you'll lose the volatility will come out of the options, and then if you're going sideways instead of vertical, the time's going to come out, okay? So buying puts when price is in a support level is going to cause the opposite thing to happen. So if you're buying puts when you're coming down to support, you don't have to turn around and go up like our last chart did, almost V-shaped. All you need to do is just hang out there for a few weeks, and all the premium is going to come out of your options, and then, of course, you've overpaid. So notice how many weeks on the next few slides it's been taking the dollar to absorb this new supply at 78 before it can rally higher. So here, on the next chart here, notice for 4 weeks now, we're hanging out here at 78, and on the left is that big supply level that we're trying to absorb so that we can make another move to new highs. So in other words, this is the only thing to me that trading is all about. There has to be support, or there has to be some kind of sell orders on the left side of the chart to prevent us from moving higher. If not, we would have just blasted through.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.